Hey guys, welcome back. We've got another important subject to talk about today, and this one is going to be a key pillar in your long-term financial plan. Renting is good when you're young and when you're still getting established, but buying a home will be a foundational element of your finances all the way into retirement. Before we get too deep, I just want to give a quick reminder that this video ties in closely with the rest of the videos in my How-To Personal Finance series, so check out the rest if you want to get a better understanding of the basics of personal finance. And also, please don't forget to like and subscribe for more content. Okay, so today we're talking about real estate. Everybody needs a roof over their head, and you have two options, rent or buy. There are plenty of advantages to each, and your personal situation might not call for buying a home right now, but sooner or later, you're probably going to want to. Once you get to a point in your life where you're starting to settle down in a place where you can see yourself for more than 5 years, you want to start taking a long, hard look at buying your first home. In today's world, many people are either uninterested in purchasing a home or are convinced that it's not something that they'll be able to afford. In the short term, renting can seem attractive because it requires much less money up front and somebody else has to take care of the maintenance. However, in the long run, you're losing out by renting. And the notion that you won't be able to afford it definitely isn't the case if you put in the time to get your finances in order first. We've already discussed laying the groundwork for your finances, so I won't go into detail, but as long as you can save up a few $1,000s and get your credit in decent shape, you should be able to afford a home. Let's get one thing straight though. You need to temper your expectations of what a first home should be. A starter home shouldn't be a 5-bedroom house with a 3-car garage and custom walk-in closet big enough to fit 200 outfits and 100 pair of shoes. Something like that is never going to be realistic as a first home for the vast majority of people. Your first home might not even be a standalone house. It may be wiser to go for something like a 2-bedroom condo. It might not be glamorous, but after a few years you can think about something nicer or larger. The key thing here is to start building up equity. What is equity? Equity is the value that a financed asset provides to you, or in our case here, how much value a home provides to you. Equity increases as you pay off the debt you took on to buy something and also as it appreciates in value. When you go to buy a home, you're most likely going to have to get a mortgage to pay for it. Mortgage is just a fancy word for a loan. Since most people don't have enough money saved up to buy a home outright, you'll first go to a bank and apply for this mortgage loan. When the bank approves you for a mortgage, they're going to give you the money up front to buy the home. However, with a mortgage, the bank retains some rights to take ownership of the home if you don't pay your mortgage back. Every time you make a monthly mortgage payment, you build up more and more equity in the home, meaning its value to you increases more and more. When you eventually pay off the mortgage entirely, the bank will give you the title to the home, which gives you full ownership. Even if you decide to sell the home before you pay off the entire mortgage, you're very likely to be in a better financial situation than if you had rented. When you go to sell the home, you're going to take the money that you get from selling to pay off the rest of the mortgage. Hopefully you end up selling the home for at least as much as you paid. The money that you get from selling is used to pay off the rest of the mortgage, and whatever money is left over is yours. The money left over is going to be the equity that you've built up from paying off your mortgage and whatever additional money was made from the appreciation of the home value. So we'll take a quick look at an example with some actual numbers in just a minute. But before we do that, let's just go over some basic mortgage lingo. When you take out a mortgage loan, the amount that you borrow is going to be called the principal. Over time, the bank is going to tack on interest to this principal to make money off their investment that they're making by loaning you their money. So when you take out a mortgage for some amount, you're actually going to end up paying back much more than that because of the interest that the bank charges. Okay, so now for the example. Let's assume that you've saved up $10,000 for a down payment on a home. The house you want to buy costs $100,000. The $10,000 down payment goes directly towards the cost of the home, so you're left over with $90,000 for your mortgage principal. Most commonly, people get a 30-year mortgage at a fixed interest rate. Now, this is a really long time for interest to be applied to a loan, so for the first few years that you're paying your mortgage, you're actually going to be paying a lot more money towards interest than principal. If you have something like a $500 per month mortgage payment, you're actually going to be paying maybe $350 of that in interest and only $150 of that towards principal. Paying off that principal is what is going to actually build equity. So you buy the home and decide after 5 years that you want to sell it. By this time, you've been paying your $500 per month mortgage payment for 60 months straight. And we said that out of this $500, $150 of it was being paid towards the principal. So this means that the 60 months multiplied by $150 per month paid towards principal means that you've paid off $9,000 of the principal. So now, even if you sell your home for exactly what you paid for it, you've made yourself $9,000. Compare that to if you had rented that whole time. If you had the same rent payment as your mortgage payment, you would have lost that $9,000 forever. Renting has its perks, but it's also a black hole that sucks up your money never to be seen again. But take into consideration that real estate generally appreciates over time. Sure, there are downturns, but in the long run, you're pretty much guaranteed to be buying something that is going to appreciate in value. In comparison, your rent is likely to only increase. Here's an eye-popping article from apartmentlist.com that shows that between 1960 and 2016, inflation-adjusted rents increased by 64% in the United States. When you buy a home, you won't ever see an increase in the monthly mortgage costs that you lock in as long as you apply for a fixed-rate mortgage. In approximately the same time period, a few interesting things happened with home buying. In this first chart, we can see that the total cost of buying a home has fluctuated quite a bit, but has actually remained relatively steady since peak total cost in the 80s when we adjust for inflation. In the next chart, there are two obvious trends that we notice. Since the mid-80s, the average home sale price has continued to increase when adjusted for inflation. At the same time, the average rate for a 30-year mortgage has fallen. This explains why the total cost of homeownership hasn't really changed. But more importantly for you as a home buyer, when you purchase a home, you're likely going to see the home that you buy continue to appreciate in value, while interest rates continue to drop. Essentially, this means that today it's easier than ever to build equity in your home with interest rates being so low. So you can build up equity, and then when you're ready to sell, your home will likely have appreciated in value. Buying a home also has a big impact on your retirement planning. Housing is the largest cost that most of us have from month to month. If you can buy a home and pay it off by the time that you retire or shortly thereafter, you can eliminate the largest monthly cost that you have and ensure that you'll have a roof over your head throughout your retirement. This is also important to help keep your living costs in retirement predictable. If you were to retire as a renter, that's going to be a large expense that will make it much more difficult to ensure that you have enough retirement savings to last the rest of your life. Rent will take away from what you could be spending on things that are more important to you. Not only this, but your rent payments will likely continue to increase as you're draining your retirement savings. This can become a precarious situation and really strain your golden years. So let's talk about how you can afford to buy a first home, since that's the biggest obstacle that most people face. You'll be putting yourself into the best situation if you have a high credit score and have a 20% down payment saved up, but that is extremely difficult for most people. If you can come up with a down payment of 3.5% of the value of the home that you want to buy and have a credit score of 580 or higher, you can apply for an FHA loan. FHA stands for the Federal Housing Administration, and these mortgage loans are designed to help those with low to moderate income. An FHA-approved lender issues the loan to you while the FHA guarantees it. Even if you don't meet the 3.5% down payment or 580 credit score requirements, you might still be able to get an FHA loan. If your credit score is above 500, you can still get an FHA loan if you're able to put down a 10% down payment. And additionally, you might be able to get help with the down payment in the form of a gift or assistance programs that may be offered by your county or state. Although an FHA loan gives many people access to homeownership, it also has many downsides. Since you aren't typically putting down a very large down payment with an FHA loan, you are required to pay for mortgage insurance, which is an addition to your monthly mortgage payment that helps protect the lender if you can't pay your mortgage. With a conventional loan, you have this mortgage insurance also if you put down less than a 20% down payment, but you can stop paying the mortgage insurance once you've built up enough equity. The amount of equity that you need to build up is 0.22 or greater when you divide the mortgage amount that you are issued by the appraised property value when you buy the home. This is called the loan-to-value ratio. There are just a few other considerations that you're going to want to keep in mind when buying a home. One is that you need to make sure that you plan for some additional upfront costs. Whenever you buy a home, you're going to have to pay closing costs, which typically range from 2% to 5% of the purchase price. These are just fees that are part of a real estate transaction, which include things like the appraisal fee and home inspection fee. You should also make sure that you consider the total cost of home ownership when you're determining how much to spend on a home. Don't forget that you're going to have to pay for things like property taxes and home insurance. You might also need to pay HOA fees or utilities that you might not be used to paying if you were renting before, like a garbage collection fee. Also, you'll probably want to make sure you have some money left over in the bank after purchasing your new home to pay for some things that you might want or need for your home. If you're upsizing, you might need or want additional furniture, or maybe you find some minor repairs that need to be made. There's a good chance that something will come up that you hadn't thought about or anticipated, so make sure you have money set aside to address any issues that pop up. I think that covers everything that I wanted to talk about in this video, so thanks for watching, and I'll see you next time.